What's up everyone, it's Kadi with Money Investing. In this video, I wanted to break down a research paper by Rob Emmett and Omid Shakirina, and I do apologize for the mispronunciation there, but they did a paper and it was published in April of 23, so this month, on how transitory is inflation. So I want to break down some of the findings from that paper. It was quite interesting because it does suggest that inflation, for it to come down, it's going to take an average or median of about 13 years. So hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to all the buy and sell alerts, options alerts, trade ideas, everything's going to be included, link down below. And the fundamental and tech analysis courses currently still 60% off. I've extended that sale for one more day, and the coupon code is going to be Easter. So this right here is going to be that paper, How Transitory is Inflation. I want to actually read you some of the things that they have talked about on this paper and kind of share my thoughts and explain exactly what the key takeaway is going to be. So first thing they mention is that history tells us that once inflation genie is out of the bottle, it can take far longer to return to normal levels than most people realize. Indeed, when the Federal Reserve Chair Paul Volcker took office in 1979, he pushed the federal funds rate to an unprecedented 20%, 5% above the previous peak inflation rate, the equivalent to today's Fed embracing double-digit rates. Even so, it took 2 more years for this extreme policy intervention to cut inflation to half its peak level to 7%, and over 6 years to bring inflation down to 2%. So just from that first reading, you can kind of understand that inflation is stubborn, right? Inflation is extremely stubborn when it actually gets out of the bottle, right? When the inflation genie is out of the bottle, it becomes really stubborn. Now, what this paper does is that it analyzes 14 developed countries, okay? And there are going to be 67 published studies on global inflation and monetary policy. And they try to analyze different thresholds of inflation: 2%, 4%, 6, 8, 10, and 12, okay? And 20. 20 is kind of like an extreme. But these are all the thresholds that they have analyzed, and every single 14 developed countries in the last 53 years, every time it's kind of approached a certain threshold, how long it's taken for inflation to recede back down to 2%, which is the target at most central banks in the world. So that's exactly what they have analyzed, and we're going to come back to some of the key takeaways here. But if we read further into this report, I want to go over some more things. So they mentioned that the good news is that 66 cases of inflation rising above 4% and unambiguously in the cresting or accelerating camp, cresting meaning coming down, or acceleration camp, 30 were cresting, meaning they were moving lower. They were coming down once they got up to over 4%. So nearly half of the episodes of 4% never went to exceed any higher thresholds. So in other words, of the 66 cases they were analyzing, 50%, right? 30 of them, normal, almost 50%, got up to 4%, and then they moved back lower, right? They receded back down to 2%. They never went back higher to higher thresholds. The bad news is at 6% and higher inflation, as it happened in 12 of our 14 countries in 2022 is what they mentioned, cresting inflation is the exception, not the rule. Once the 6% threshold is surpassed, they mentioned inflation marched to the next threshold and often well beyond 82% of the time. And that's exactly what happened with the US, right? Once it passed 6%, it got up to as much as 9%, right? Not only did it break past 6%, but it also broke past the next threshold, which is 8%. And we peaked, I think, back in June at over 9%. Now, another thing that I want to mention from this research paper is going to be what the actual analysis and, of course, some of the other case studies as well. So what you'll notice is that they are not posing the question, how fast can inflation subside, because there's one singular focus on price stability. Like if governments wanted to reduce inflation tomorrow, I mean, they could, right? They could pretty much do that as they have done in the past. So know that the singular focus on price stability can rein in inflation almost overnight, as was the case with German and Austrian hyperinflation 1920s, Hungarian hyperinflation 1940s, Zimbabwe hyperinflation in 2000s. In each instance, deficit spending, money printing, and central bank purchases of government debt were stopped cold and inflation immediately ended, right? So if pretty much we kind of reduced deficit spending, no more money printing, no more central bank purchases, inflation was stopped cold and immediately kind of receded back lower. So it's not a singular question if that can happen, because it can, but obviously it's not going to happen because we are still constantly running the deficit. There is still some level of money printing, and the banking crisis only accelerated that a little bit more. In some cases, the failed currency was abandoned in favor of a broadly trusted medium of exchange, typically gold or then prevailing reserve currency as well. But reading further, now this is where things get really interesting. And this is basically telling us when we widen the aperture beyond 2022 and look back to 1970s, we observe a total of 28 instances when inflation rate of any of the 14 countries surpassed 8%. And remember, in 2022, inflation in the US also surpassed over 8%. So over this 50-year span, Great Britain and Sweden had 3 such episodes over their histories. Switzerland and Germany exceeded 8% inflation only once. And the remaining 10 countries, the majority of our countries, which they analyzed, the 14 countries, each experienced 2 distinct episodes in which the inflation rate surpassed 8%. And US is part of one of those countries, right? Where inflation did surpass over 8%. So what was the aftermath for the 20 episodes that have been resolved, subsequently receding below 2% inflation? Only 2 of these were cresting, meaning they were moving down. Both subsided below 2% within 2 years. These episodes took place in New Zealand and in Japan. So New Zealand in 1990 and Japan in 1980. And this is what the investment community, politicians, economists, and pundits are collectively expecting with the US most recent foray of above 8%. So in other words, in the last 53 years, of the 28 instances that we have seen for inflation to be above 8% in these developed economies, only 2 times we've seen inflation recede back down to 2% in 2 years. And that's what this paper is suggesting. That's what pretty much majority of politicians, investment pundits, everybody in the community is expecting, that inflation is going to recede back down to 2% within 2 years, considering that's happened with New Zealand and Japan in 1990 and 1980 respectively. The other 18 episodes, fully 90% of the 20 cases that have run their course, not 28, but 20 cases that have had inflation over 8%, they went on to new highs above 10%, 5 lofting above 20% before settling back down to 2% inflation. And this return to normal required anywhere between 2.5 to as much as 26.5 years, with a median of 13 years. Of all accelerating episodes, nearly 1/4 of these episodes required 20 years or more to recede below 2%. And from the first time inflation crossed over 8%, over half of the paths required at least a decade to recede. So if we come back to the key takeaway, which was kind of mentioned in the beginning, you'll notice that inflation jump to 4% is often temporary, but when inflation crosses over 6%, it proceeds to higher levels over 80% of the time. So it's possible that it gets up to 8, 10, 12%, and it did for the US. When inflation crosses 8%, reverting to 2% usually takes 7 to 22 years with a median of over 13 years. In other words, inflation can be incredibly stubborn in it coming down to 2%. That's what they have pretty much mentioned in this report. One more thing about the Federal Reserve that they talked about towards the end. And again, I'll leave a link down in the description below if you want to read this paper for yourself. But they pretty much put together a dot plot and how the Federal Reserve obviously was behind the curve way too much when inflation started to push up. So you can see that, this is back in March of 2021, when inflation was already getting up to as much as 4.5 to 4%. And even then, the dot plot was expecting interest rates to be very much in the 0% camp, 0 to 0.5%, as much as 1%. That was their expectation. They weren't expecting for rates to go higher, even though inflation at that time was already on the way up, because there was all this transitory narrative happening. This right here was June of 2021. So the second quarter 2021, inflation stabilized a little bit at around 5 to 5.5%. And yet most FOMC members still did not expect interest rates to be higher by the end of that year. This right here is going to be December 2021. So fourth quarter 2021, inflation continues to charge higher in rampant acceleration, getting up to 7 to 7.5%. And yet still, the FOMC members in their dot plot were suggesting little to no change to interest rates, expecting somewhere between 0.5 to 1.5%. And it wasn't until more recently in the Q3, Q4, as we have seen the dot plot kind of increase the interest rates up to 4.5%, 5%, and 5.25%, getting now starting to become more and more aggressive with respect to interest rates as inflation starts to stabilize a little bit. Now, they also did talk about what is happening in 2023, which I want to read you this final paragraph, which is quite interesting. So they mentioned that the current year, 2022, paints a different picture. By mid-September, the governors were forecasting a consensus year-end Fed fund rate of about 4%, on track to create a full yield curve inversion. That was the yield curve inversion between the 10-year bond and the 3-month treasury, or the 10-year with the 2-year. Whatever you take, they're all inverted right now, suggesting a recession. But inflation remains stubbornly at 6.5% through the year end. And during the first half of 2023, each monthly report, this is important, each monthly report will be replacing the lofty inflation from the first half in 2022, averaging over 1% per month. So in other words, if you compare first half of 2022, we were averaging over 1% per month in inflation, and that is what is going to have that comparable effect. And as a result, it'll be utterly unsurprising if the media, policy, elite, and capital markets applaud a, quote, win against this 2021-2022 inflation surge. However, in the second half of 2022, headline CPI was very near zero. So we started to come down. Remember, after June, we started to see inflation roll over. June, July, August, September, October, November, December of last year, inflation's been coming down. So headline was near zero. So each monthly report will replace inflation averaging zero with something new in the second half of this year in 2023. It will be equally unsurprising if the commentary begins hand-wringing about a renewed surge in inflation. Both narratives should be taken with a grain of salt, as the likely drop and rebound in inflation will be an illusion, an artifact of the peculiar pattern of inflation in 2022. And last but not least, a yield curve suggests that an inversion from the 3 months to 10 years, if it remains inverted and average over a quarter, has a 100% batting average over the last 50 years in predicting recessions with no false positives, meaning that if the inversion continues to happen on average for a quarter, for 3 months, it has a 100% batting average with no false positives that we are going to see a recession, and has suggested that yield curve inversions don't just predict recessions, they actually create them. So that was the entire report, which is quite interesting. Came out literally in April of 2023, that I wanted to break down for both inflation and recession, going over historic developed markets and kind of analyzing. And then again, shout out to them for writing this paper. Let me know your thoughts. Let me know what you think about this, and how transitory do you think inflation is going to end up being? But that's quite a bummer that this paper does suggest that on average, it's going to take somewhere between 7 to 22 years for inflation to recede back down to the lower 2%, with a median of about 13%. Now, this paper does not mean that, it's actually going to take that long. Of course, 2023 is completely different than any time previously studied. Money supply has been contracting. There is recession probabilities higher. So it's possible that we still land in that anomaly, the top quintile, top 25% probabilities where inflation does recede back down to 2%. If things start to weaken in the economy, if there's a recession, of course, labor market continues to weaken and money supply contracts. It's possible that we see that, but it's only happened 2 times in New Zealand and Japan. Out of all the studies, out of the 20 times that they've studied, when inflation has crossed that threshold of over 8%. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.